Fed hikes interest rates by 75 basis points again. As inflation is surging, this is the second consecutive time. Back-to-back increases are the biggest since the early 1980s. Some key points, 3. Take a look at this. The Federal Reserve on Wednesday enacted its second consecutive 0.75 percentage point interest rate increase, taking its benchmark rate to a range of 2.25% to 2.5%. Mr. Jerome Powell, the chair, the big dog, said there will be a point where the Fed starts to slow hikes to assess their impacts. Really? Number 3, we actually think we need a period of growth below potential in order to create some slack, he said. I don't know what that means. The Federal Reserve continued its campaign of aggressive interest rate increases today, hiking its rate target, so another 0.75 percentage points, while acknowledging, at least there was some acknowledging for the first time, that recent indicators of spending and production have softened. They've softened. So the Federal Reserve on Wednesday today raised its benchmark interest rate target by 0.75 of a percentage point. So what's the why behind this? Why does this matter? The Fed's tightening of monetary policy, the most rapid in decades, is intended to bring down inflation, but it won't. It has also sent financial markets reeling and increased the risk the United States will fall into a recession. We already have 1 quarter of negative growth. We're getting ready for another one this Thursday. So the Federal Open Market Committee, which sets interest rate policy, said its target rate for overnight interbank funding would raise to a range of 2.25% to 2.5%, up from the 1.5 to 1.75% the Fed set last month. In addition, the Fed said it would raise the rate it pays on reserve balances to 2.40%. So while the Fed funds rate most directly impacts what banks charge each other for short-term loans, it feeds into a multitude of consumer products such as adjustable mortgages, auto loans, credit cards. The increase takes the funds rate to its highest level, ladies and gentlemen, since December 2018. So, the Fed officials are getting together for the coffee and Danish and the staff. So the economists, disagree amongst themselves about the effect of its large-scale asset purchases and the inflation of its balance sheet. Some officials consider the balance sheet reduction to be equivalent to rate increases. So what is that? That's basically another form of monetary tightening. So the Fed hike comes a day before the government is expected, which this Thursday, to report the rate of growth of the U.S. economy in the second quarter. We've had 1 negative quarter of GDP. So the median forecast among economists surveyed by the Wall Street Journal is that the economy grew a mere 0.3%. I don't think so. A growing minority of analysts, however, think the economy likely contracted in the second quarter. The Atlanta Fed's GDP Now real-time tracker on Wednesday today sees the economy shrinking 1.2%. So, the U.S. economy, as we all know, contracted 1.6% in the first 3 months of the year. 2 consecutive quarterly contraction is often considered 100% a recession. The National Bureau of Economic Research, it's a private outfit founded in 1920. That is the semi-official arbiter of recessions, uses a more complex and subjective definition. It says a recession is a significant decline in economic activity that is spread across the economy and lasts more than a few months. So often the NBER's declaration of a recession comes several months after the start of the downturn. Maybe we're in a recession right now. If you're boots on the ground, you know what's going on in the world. So the Biden administration has been insisting that the economy should not be considered. They want to change the rules. Not be considered to be in a recession even if it shrinks in the second quarter. Can you imagine if the last administration said that, pointing to the historically low unemployment rate? Critics have said the administration is attempting to redefine what a recession is to avoid being blamed for a serious downturn. We have an election year coming up. I get what's going on. So the bottom line, 2 consecutive quarters of negative GDP means we are in a recession. We know it's a political year, and the current administration is trying to dance around the issue. We are in a recession. We are in a recession right now. You know, I'm seeing those RVs and vans packed with people all over the roads now. So when you look at this between the lines, the language in the statement about spending and production indicators softening is the most explicit acknowledgement for the first time, because it was transitory for over a year, from the Fed that the economy is slowing. So the rate increase campaign is intended to slow demand. So in that sense, softening spending reflects the Fed's policies achieving their goals. But the statement also noted that job gains have been robust in recent months and the unemployment rate has remained low, repeating language from the past months, just repeating that standard line. Like I said in the past, part-time jobs are created. A lot of people have fallen off. So we all know the history of the unemployment rate. So the White House also drew scrutiny for bragging about the downtick in prices, with some questioning whether the victory lap was premature, just as peak summer driving season, folks, gets underway right now. So earlier this week, Treasury Secretary Janet Yellen opened her mouth again. She's been political, pointed to the ongoing strength in the U.S. labor market as a sign that the U.S. economy was not in a recession. Okay, this is not an economy that's in a recession, she said, but we're in a period of transition. These are the same people who said it was transitory for a year, in which growth is slowing. That's necessary and appropriate, and we need to be growing at a steady and sustainable pace, Yellen told NBC's Meet the Press. Now, Yellen got on TV and apologized for saying inflation was transitory. They knew it wasn't transitory, but they were told by the White House to say that. So meanwhile, Treasury Secretary Larry Summers, he's a frequent critic of the Fed's response to inflation crisis, warned a very high likelihood probability we are in a recession. He worked under Barack Obama. So when he basically said when we've been in this kind of situation before, recession has essentially always followed. When inflation has been super high like this and even unemployment has been low. Summers told that to CNN. Soft landings represent a kind of triumph of hope over experience. People in the game know what's really going on. So the hope, So I think what to watch, what the Fed will do in the months ahead is less clear. Powell told reporters that the central bank will be evaluating how much further to raise rates on a meeting-by-meeting basis now. So as it watches incoming economic data for signs that inflation is slowing down. So Powell said, another unusually large rate increase could be in the cards in the next meeting, but still he doesn't expect to give that kind of clear guidance as he has in previous months. So I don't know what to believe anymore, folks. So these rate hikes have been large, very large, and they've come very quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. In so many words, that's what Powell said. So let me just be very clear. We have people saying inflation, number one, across the media is because of the Russian war. We all know, and COVID. COVID is pretty much over, okay? We had inflation before the Russian war. The real problem is when Joe Biden got into office, he did 40-plus executive orders, and one of those executive orders was to shut down our energy. So gas went from $2 and skyrocketed. If we didn't shut down our energy, even with the Russia war, even with COVID, okay, we wouldn't be in this predicament that we're in. So right now, our enemies and our adversaries, China, India, Russia, are producing oil. They're going to stick with fossil fuels. Wind and solar cannot power a modern economy right now. It's 40 to 50 years out. Can't do it. By the way, wind turbines run on oil. To lubricate all those parts, they run on oil. To make solar panels, you have to use fossil fuels. Wind turbines kill birds. Large amounts of solar panels can be bad for the environment. So the technology is not there. I'm all for green. And our oil is the cleanest, most refined in the oil. So now we're importing oil, dirty oil from our enemies and adversaries, other countries, that's dirty and that's polluting the environment. When we could refine our own oil, it's refined. We use clean coal, not dirty coal like China. So the problem I just want to get across is we shut down our energy production. If we went full tilt, drill, baby, drill, we would not be in this predicament. You can't blame it on the Russia war, and you can't blame it on COVID. All right? So interest rate hike increase, we got to keep an eye on it. A lot of moving parts right now. It's going to get a little wild out there. Take care.